Hi everyone, welcome to Trading Week. This is Chris Becker, the Prince from MacroBusiness. What I'm going to do in this podcast is just go over the 10 major markets that I follow each week and I update. So we'll start with 10-year treasuries. This is a chart of bond yields. So as yields fall, prices go up. And it's a good indication of the risk on, risk off memo you might have heard. So basically what we have here back in 2008, the time of the GFC, bond yields were around about 4%, and then they sharply fell down to 2%. Now why is that? What happens usually, risk markets move away and then to bonds. They see US bonds particularly as a safe haven. So when there's too much risk in the markets, they immediately buy bonds, therefore the yields fall. So that's what happened back in 2008 through the early 2009. We had QE1 and 1.5 to inject liquidity into the markets. So bonds were dumped and stocks and commodities were bought up. So obviously yields came back up. They came up about 3.8 and they stayed there until we had what I call European Crisis Mark 1 back in May 2010. And with that crisis we had a return to bonds. So bond yields fell again down to 2.4. And then shortly after, of course, we had QE2. Bonds were sold off. We're back up again to a structure around about just over 3. And then we had European Crisis Mark 2 back in April 2011. And again, we saw another sell-off of risk and bonds were bought back. And they fell this time to 1.8, which is an amazing return for a 10-year government bond. Not so amazing if you're Japanese, which is almost zero. So we've had this structure recently here, you can see here. I'll just zoom in using a daily chart. So this is from July last year. This red line, which you'll see on all my charts, is just a 200-day moving average. I don't use anything else. It's quite a clear and simple indicator to use. You can see we had this pattern here from October, November, where bond yields stayed down. They jump up a little here on this base, above 2%, and then they broke out in early March. Now above the 200-day moving average, you can see that there. This was a call to say, hey, the bond market's over, the bond bull market is over. A bit too early, of course, so now we'll come back down again. A lot of people are very bearish on US bonds, which is surprising given history of monetary policy in Japan in deflationary periods. I'll explain a bit about that in a later podcast. Let's now go back to, let's follow the US again, and we'll go to the US dollar index. The US dollar index is a weighted basket of currencies against the US dollar. So you've got the euro, you've got the pound sterling, yen, and of course the Aussie dollar. I won't go over the history lesson, it's pretty much the same with the US dollar. It's a risk on, risk off currency since the GFC. We'll just quickly go down to the most current period. That's the weekly chart. We had a bottom here in May through to August, and then the US dollar rallied. I use green lines there for an uptrend. And there's a 200-day moving average again. I'll go to the daily chart and we can have a better look. We'll just zoom out to, there we are. And what we've got there is what's called a symmetrical triangle. Now just clarify that again. I don't use patterns to trade, I use patterns to explain what's happening in the market. What we've basically got here is a bullish bias because all this price action is above the 200-day moving average, which is rising. But now it's springing like a coil. So we're getting shorter and shorter oscillations between these two lines. And if we see a breakout above 80 points, that usually should mean risk off because going to the US dollar is a safe haven. And if we see a breakout below 79, but I would prefer to see one below 78.5. So if we see a breakdown down here, that's risk off. Risk on, sorry, risk on. So, you know, we'll see markets moving to the euro, to the Aussie dollar, and so forth. Now, why is that? Why is that risk on? Well, the Aussie dollar is the best proxy for that. So we'll just have a quick look at the Aussie dollar. In fact, we'll zoom out a bit more because I just want to explain what goes on with the Aussie dollar. For those of you who are familiar with what happened previously in the GFC to now, you can see that the Aussie dollar is basically a proxy for risk. and in fact it looks like it's gone too far, given the height during the GFC was only 96 cents. We went up to $1.10. There's macro factors here as well, of course. I won't explain them now, but let's just zoom in to the last couple of years. Now this structure here on the left was a base after the initial round of liquidity for QE1, QE 1.5, and then it jumped out of that base from QE2, and here it is there, that big jump above, and now we've stabilised around $1.03 using the 200-day moving average. You can see it there. In recent weeks we've had a dip from $1.07 to $1.03 as the markets may have fully realised that interest rates are going to come down in Australia, but for the moment I'm looking just for a trading range here between 96 and $1.10. It's a big range, I know, but the one important one to watch is parity. So if we see a break below parity, which we saw back here in a high volatility range in October through to Christmas last year, if we see that break through to 96 and below, you can pretty much call the Aussie dollar off, because it's the fifth most traded currency in the world, and if it's below that, that basically means risk off for everyone. We'll have a very quick look at the euro, and then I'm going to go on to commodities. The euro dollar, again, I always start this with a long-term chart, so we're going to go back to its inception back in 2000, 2001. You can see it rallied against the US dollar, and it's had this pattern, this pennant type pattern ever since. And if you look in recent history since 2010, to my mind, that looks like a head and shoulders, but we've had very, very strong support there at the $1.30, sorry, $1.30 euro level, and that's the one to watch in the weeks ahead as this crisis unfolds. So here's the weekly chart that I'm following. Again, you can see that 130 level temporarily, so you might see that jump down there in the next few weeks to about the 128, 129. But if we see a weekly or a monthly move below that, and we do have a bearish bias, because you can see that 200-day moving average is pushing down since mid last year, could be down to parity for the euro, so that's one definitely to watch. All right, let's go to commodities. And we'll start with gold, which some contend is a currency, so maybe I'm talking about the same thing. So we'll go to a monthly chart, and we'll actually zoom as far as we can, because you can see the secular bull market in gold. It's had a massive rise from 270 odd US dollars per ounce, and now it went up to almost 2,000 within 10 years, so that's a huge rise. This is a semi-log chart, by the way, so that's a logarithmic scale. If I just turn that off, you'll see, that's, is it a bubble? Well, we'll leave that to another day to discuss that, but that's a classic exponential rise, isn't it? Okay, let's just go back to what's happening. We'll go to a weekly chart, and we'll go back to see what's happening the last couple of, this last year or so. We had this very bubblish sort of rise past $1,800 to $1,900, and we've had a correction in recent months. So I'm just going to go to the 1 year chart. I did contend that this was an inverse bull and bullish head and shoulders pattern. Again, I don't use the pattern to trade, but just to give an idea of what's going on. So far, I've been wrong. It hasn't worked out that way. I'll go to the daily charts here, just to give you an explanation of what's going on in the short term. There's resistance here at just below $1,800 an ounce. It's tried to get it 2 or 3 times, as you can see here, back in February and then back in November last year. This is the most important thing to watch, is it fell below the 200-day moving average, which for the last 11 or 12 years, gold has always respected. So once it falls below that, you get people bidding it up. It's done that again here, and we're oscillating again, and this is a triangle type pattern. So we're oscillating around about 1650 level. So that's what I'm watching closely at the moment. Obviously, a breakdown here to $1,600 is bearish for gold, and a break above should mean either a sideways bullish sort of move over the next few months or a continuation of the secular trend. And of course, $1,800 is the main move. We've got to see that go past. The thing to remember with gold is it did correct 25% during the GFC. It's not the perfect volatility hedge. It is a speculative commodity. So